Thank you for joining us for the Chamber Economic Forum. I'm Fred Martino. We want to say a big thank you first to the Greater Las Cruces Chamber of Commerce for partnering with us on this regular event. And I'm pleased to tell you we have in the studio our regular guests from New Mexico State University, economists Dr. Jim Peach, Dr. Chris Erickson, and Dr. Ken Martin. And as we always do, we begin with a look at the national economy, how things are going. And Dr. Peach, good evening.
Good evening, thank you. And thanks to the Chamber and to KRWG as usual. This is great fun because I get to give you the good news about the national economy, and my colleague Erickson can depress you with the news about the New Mexico economy, and perhaps Professor Martin will burst your bubbles on financial issues. It really is good news this time about the national economy. I'm sure most of you have heard about the report of the first quarter growth in real GDP that a lot of people described as disappointing of 0.1%. There are a lot of reasons not to pay much attention to that number. Number one is that we all learned in high school that it takes at least 2 points in a ruler to draw a line, even a trend line. You shouldn't pay much attention to a single data point. The second one is that most analysts look at that and say, we had horrendous weather in a good part of the first quarter. A third thing is that all of the data from March and even some of it from February indicate that we're back on the upswing again. We just shouldn't even worry about that. I think we'll probably hit 3% in the second quarter, and that would be a good growth rate. Even if you look at the first quarter growth rate and you say, oh goodness, 0.1%, that's a terrible growth rate of real GDP. That's a quarter-to-quarter change at an annualized rate. And if we had an hour or so, I'd explain the formula to you. But if you look at the simple percent change from the same quarter a year earlier, the growth rate was actually 2.3%. So we're better off than we were. If we look at employment data, we have had 43 straight months of employment increases. And last month, April, was an especially good month with 288,000, and there were upward revisions for the previous 2 months. So we're doing all right on employment. And it's kind of fun, next month, if things go right, if nothing strange happens, we will have equaled the number of jobs in the U.S. economy that we had at the start of the Great Recession in December '07. Now, that's both good news and bad news. The nation will have come back to at least the level of jobs that we had 7 years ago, 5 years after the official end of the recession. The official end was in June '09. In May, we're likely to be back to where we were in December '07, and that's good. It's slower than anybody would like. We all know why that has occurred. The stimulus package was far too small. The policy response to this was far too timid. But that's all good news. And then if we begin to look at particular sectors, we're doing pretty well on some sectors that count. It's not just New Mexico that is having an energy boom. Oil and gas production throughout the nation is increasing at rates that nobody thought would have been possible 5 years ago. The energy boom has side effects, including an increase in manufacturing activity nationwide. New automobile sales are likely to be right at 16 million this year. That's almost where they were in 2006, 2007. We hit 17 million in '07. And we may see a 16 million, 15 million range for quite some time, in part because cars last longer. despite all of the recalls, and people are driving less. So if we get 16 million sold this year, new cars, that's a really good number. If you look at housing, housing is a little bit troubling. Housing starts are not back to where anybody would like them to be, especially single-family housing. And there was a report just within the last 2 days that something just over 40% of all new houses sold last year were sold for cash. And what that means is that those are investors, speculators if you like, buying houses, betting that the price will go up at some point and they'll be able to make a profit. Nothing wrong with that, but traditionally that figure is in the 15% range and we're at 43%. So it's not the traditional American home buyer who is buying those houses. It's not the single family purchasing their first home or purchasing a second home that's doing that. In fact, the Census Bureau reports that family formation has dropped considerably. We've had about 1 million, 1.2 million new families formed on average in the early 2000s, and last year the Census Bureau reports that that was about 480,000. That will pick up as the labor market picks up and people have jobs. Kids are staying at home, living with their parents, not getting married because of the labor market conditions. But if you look at the overall picture there, there's nothing that really threatens the continued growth of the U.S. economy over the next year or two. We have dispensed with, I hope, the fiscal crises that we've had over the debt and over the budget. That's not looming this year again. Monetary policy, the Fed is beginning to taper. That's a sign of a much healthier economy. If we don't go to war with Russia over the Ukraine, and I don't think that's really going to happen, there's not too much on the international front that threatens the stability of world economies. And so we ought to be all right for the next year or two. Most of the forecasters that I've looked at, I often, when I have a PowerPoint, I have a slide called the usual suspects, and I round up a half a dozen different forecasters are predicting a rate of real GDP growth in the United States of 2.7, 2.8, a couple of them 2.5% for this year. I think it's going to be a bit higher than that. I'd be very surprised if we didn't hit 3% in the second quarter and that the second half of the year wasn't even higher than that.
Okay, so as you indicated, lots of reason for hope, but you also mentioned Dr. Erickson doesn't have as much fun here tonight. Not as good in terms of the picture for New Mexico or the region.
That's right. Well, I think the way I'd summarize it is that Las Cruces is doing okay, but that the state as a whole is having a lot of problems, particularly in Albuquerque. New Mexico's employment growth compared to the other 50 states since the recession began in December of 2007, and since the beginning of the Great Recession, New Mexico has the slowest employment growth of any state. And so we are lagging behind in our recovery. So employment growth since the recession in New Mexico has been minus 4%. That compares, as Jim said, to the slightly negative minus 0.3% nationally. But for Las Cruces, employment growth has been 1.6%. So Las Cruces is actually doing better than either the national or the state. Now, I don't want people to jump up and down over that, because if you figure it out, we're talking about 1.6% since December of 2007. That's very slow growth. It's better than the negative growth you're seeing nationally, but it's very slow growth, and you'd have to describe the Las Cruces economy as relatively stagnant. If you look at construction and real estate, construction employment is still quite low by historical standards. Housing prices in statewide are down a little under 12%, and in Las Cruces they're down 17%. That compares to a national average of about negative 12%. So that negative 17% in housing prices, it's a little difficult to know what's causing that, but I'm going to guess that the reason for that is because of the stagnation and very slow employment growth at White Sands and Fort Bliss. Up until a few years ago, increased federal spending in the area, particularly at Fort Bliss, which of course is mainly in El Paso, but still spills over into our community, was driving fairly rapid employment growth, and that of course led to higher housing prices. And that growth in the federal sector has come to an end here locally and also nationally. Housing starts, Jim mentioned it, that housing starts are not doing very well nationally. Here in the state, they are still at recession levels. They're better than they were at the height of the recession, but it's still not at a level that you'd want to see. And that same applies here in Las Cruces. Housing starts are better than they were at the very height of the recession, but they continue to be quite low by historical standards. Foreclosures, both nationally and here locally, foreclosures are doing better. The foreclosure rate nationally is about 1 in 1,100. Here in Las Cruces, it's 1 in 1,900. So we're have a considerably lower foreclosure rate than you're seeing nationally. And that brings me to what's probably the most controversial issue currently facing our local community, which is the minimum wage. And when I bring up the minimum wage, I can see people's blood pressure begin to rise on both sides of the issue. Right now, the minimum wage in New Mexico, and of course here in Las Cruces also, is $7.50 an hour, and for tip wage it's $2.13 an hour. Tip wage means that if you're earning tips, you get $2.13 an hour, and then the tips make up the difference to $7.50. If your tips aren't adequate, then your employer has to make up the difference. Nationally, of course, minimum wage is $7.25. So we have a slightly higher minimum wage in New Mexico already. The Comunidades in Action e de Fe, which is a local group that advocates for progressive programs in the area, is proposing that the minimum wage in Las Cruces be increased from the current $7.50 to $10.10 an hour by January 1, 2017, and be phased in 3 steps. And they propose increasing the tip wage to $6.06 an hour, again phased in over 3 years, going into effect in January 1, 2017. The likely impact of the minimum wage is likely to be small. Economic studies that look at the minimum wage find that increases in the minimum wage have relatively little impact on employment. On the one hand, it does increase the cost of hiring workers. On the other hand, it increases the wages that workers are receiving, and those workers spend those funds in the local economy. I've done a little back-of-the-envelope calculation, and my best guess is that the minimum wage will have no measurable impact on employment in the community if it's raised. But
raised to what?
Raised to 10.10.
Okay.
So that's a 34% increase. But at the high end, it could have an impact as much as 2% over 5 years. And that's not a lot, but it's not zero either. It's also true that the minimum wage is likely to have very little impact on the incomes of minimum wage workers, and that's because as you raise the minimum wage, you reduce eligibility for government programs, you reduce eligibility for SNAP, or what's, that's the new name for food stamps. It reduces eligibility for earned income tax credit and other programs that help the poor. And so the impact, increasing the minimum wage by 34% is not going to increase the wages of minimum wage workers by the same percentage. Is it a good idea to raise the minimum wage? Well, it depends who you're looking at. The impact on small businesses is likely to be quite negative, whereas the slack is likely to be taken up by businesses that are from outside the community. And it's also, for example, large chains are better able to absorb the cost of a minimum wage increase than small businesses in our community are likely to be able to do that. And then also, it's true that an increase in minimum wage disproportionately affects teenage workers, and so teenage workers are likely to be displaced. On the other hand, evidence indicates that those teenage workers are replaced by workers in their 20s, and so we see an increase in the quality of the workforce from very young workers to workers who tend to be a little bit older. And so on net, it's a close call whether it's a good idea or not. I tend to favor it because I think it's good that we reduce the dependency of workers. If you're working full-time, I think it's not fair that you are then have to also, and of course that's a fairness issue. Economists aren't supposed to talk about fairness. We're only supposed to talk about objective facts. But I think it's unfair that people who are working full-time also had to be dependent on food stamps, had to be dependent on earned income tax credits in order to make ends meet. And so I think it's fair that they'll be able to earn a living wage, as they say. And so I favor the increase in the minimum wage, but only just barely. And one of the proposals you hear being discussed is from the City Council would be an increase in the minimum wage to $8.50 rather than the $10.10, and I think that might be a reasonable compromise. Final comment I want to make is on graduation rates in the city. If we're going to do one thing to increase economic development in our community, it'd be to improve K-12 education. And right now, the graduation rates in our schools is at 66.8%. That's a 4-year graduation rate, and that's very low. That's is a number that needs to be brought up. And we also have underperforming on national test scores. 8th grade scores for reading, we rank as a state 3rd from the bottom, ahead of Mississippi and District of Columbia. And in math, we rank 5th from the bottom. And these are numbers that need to be brought up. Thanks.
So we start with lots of good news, a little in the middle, the news not so good, but I think, Dr. Martin, you may have some good news with the stock market.
Oh yeah, the stock market just kind of ignores the slow growth and maybe some of the state of New Mexico issues and has powered ahead. When we last met in August at this forum, the Dow Jones Industrial Average was at about 15,000, and just recently it hit an all-time record high of about 16,600, roughly a 10 to 11% gain in 9 months. And as some of you will remember, 2013 was just a fantastic year that nobody really expected. About a 30% gain for the calendar year and a melt up towards the end of the year. 2014 has been a little bit sluggish. The broad market averages are only up maybe a couple of percent. The Standard & Poor's 500 since last August is up about 14%, also near a record high. The NASDAQ index is up about 13% from last August. But it's nowhere near its all-time high, which some of us remember well in the glory days of 2000, when the dot-com bubble was near its peak. Well, speaking of bubbles and stock market highs, I thought I would talk a little bubbleology with you. And the big overriding question is, are we in another bubble? People always talk about this, and I've been reading, what brought this to my attention is I've been reading a little bit about bubbles, and I got the latest quarterly newsletter from Jeremy Grantham at GMO Inc. That's Grantham, stands for Grantham Mayo Van Otterloo. It's a big investment firm in Boston. And Jeremy Grantham is one of the deepest thinkers on valuation and on bubbles. They've been tracking bubbles since at least 1997. They identify major bubbles, minor bubbles, and major bubbles, as we saw in the dot-com bubble in 2000 and housing bubble in 2008, they always end badly. So it I think, makes sense to look at bubbles. Question is, what is a bubble, and how do you operationalize that concept? How do you go looking for them? In my mind, a bubble is extreme overvaluation. A market, an asset market, and it could be any asset market, hits an extreme overvaluation. Okay, the prices get disconnected from underlying fundamental measures of valuation. Jeremy Grantham and the folks at GMO think about bubbles similarly, but in terms of operationalizing it in a statistical sense, they look at times when prices are at least 2 standard deviations away from the mean or the underlying trend of that asset market. Okay, so let's follow that concept, and let's think about the Standard & Poor's 500, probably the biggest, most widely followed market average. Turns out that Professor Robert Shiller at Yale University, very well-known economist, a Nobel Prize-winning economist, wrote a book back published first in 2000 called Irrational Exuberance. And the data that he used in writing that book, he maintains and posts on his website as an Excel spreadsheet. It's easy enough to download and work with. And on that spreadsheet, he calculates what he calls the cyclically adjusted price-earnings ratio. The cyclically adjusted part has to do with the earnings that goes into the PE ratio. He uses as the earnings number a 10-year average of earnings from the Standard & Poor's 500 companies. That smooths out the cyclical variations that you get from economy moving up and down. It's not without precedent. Benjamin Graham, the well-known value investor and teacher of Warren Buffett, also used that kind of measure in assessing valuations. So, Professor Shiller's data go back to 1882, and the average CAPE, cyclically adjusted price-earnings ratio, since 1882 is 16.5. Where are we now? 25. But it's not a 2 standard deviation event. That today's price-earnings ratio is not 2 standard deviations above that average 16.5. That would take a PE of about 30 to do that.
So stocks are historically overpriced, but you're saying maybe it's not a bubble.
It's not a bubble.
Okay, very interesting.
If you define a bubble as a 2 standard deviation event.
All right. Final thoughts before we get to audience questions.
Final thoughts. Oh, well, I looked at a number of different asset markets, and so instead of going through them one by one, I'll cut to the chase. The only asset market that I found that seems to be at or just above the bubble territory, the 2 standard deviation event, is real estate investment trusts, REITs. And the REITs, the index REIT that I track has shopping malls and healthcare buildings and all kinds of cell phone towers, all kinds of companies in it. And it is at or above the 2 standard deviation boundary. Above, another way of looking at the trend is a long-term moving average. In what I have done is a 200-day moving average. So if you look at REITs, they have done extraordinarily well in the last 6 months to a year, and their prices are way high. So be careful.
Okay.
Let's see, one last thing, fearless forecast. Or are we going to get to that later?
We can do that. We can do that.
Okay, fearless forecast. Last time on this show, I made a fearless forecast on the Dow, and I believe it panned out. I believe the Dow was at 15,000, and using the model that I teach my students, so my students actually ran the numbers, I was forecasting about a 16,200 level of the Dow. We hit it and actually have gone through it. So now this semester, using the same valuation model, had my students run the numbers, each one of the 30 Dow components. We did a valuation on each one of those, aggregated those up to a fair value of the Dow. The number is 17,300.
Ah,
Now that's not that bold. It's only about 5% from where we are.
still optimistic though.
Still optimistic.
We like to hear optimism. We need to get more of it. We are looking forward now to audience questions for the rest of the program. We have about 25 minutes to go. We hope to get lots of questions for our economists, probably on some of the topics they've already addressed, but maybe on some new ones as well. We always have wonderful audience questions, and we again thank the Greater Las Cruces Chamber of Commerce for inviting their members and for helping us and partnering with us on this fantastic program that we do 3 or 4 times a year. We hope to kind of, in the year ahead, keep it at that level at least 3 times a year. I always enjoy this show, and I know lots of our viewers do as well. And we have our first audience question.
Thank you very much. My name is Robert Scaling, and I have a question for Dr. Peach. You mentioned early in your presentation about the employment growth for April at 288,000 jobs, and you failed to mention, and no big deal, it dropped the unemployment rate down to 6.3%. But it wasn't caused by that. It was caused by 800,000 people dropping out of the workforce. And that leads me to a bigger concern, because at least what I've read is that there are fewer Americans working today than in modern history. And maybe you can, but let me go one step further. This country's dealing with a $17 trillion deficit. And if you've got fewer people paying taxes, how are we going to recover that deficit?
Okay,
And I'll step away.
you have several questions there. Let me take the labor force question first. The labor force participation rate, which is the percentage of the civilian population age 16 years old and older who are non-institutionalized and not in the military, who are in the labor force, working or unemployed and seeking work, has dropped during the recession from 67% down to just under 63%. But that's part of a longer downward trend. And the issues here are very, very complex as to what's causing it. Some of it is being caused by the aging of the labor force. And as we get older, we have a tendency to drop out, to retire. Some of it was due to the recession itself. One report just the other day suggested that after reviewing all of the studies on it, suggested that about half of it was due to the aging of the labor force and about half of it was due to economic conditions. It is a really complicated thing. If you look at people age 65 and over, their labor force participation rates have actually been increasing the last few years. It is at the very young end of the distribution that people are not participating as much as they used to. It is not the case that we have fewer people working today than in recent history. We will have the jobs count that I gave you is based on an employer survey, and there are multiple people hold multiple jobs, so that's not a count of individuals. The labor force data that we get from the household survey gives us the count of individuals who are working, and that is also not at an all-time low. Real quick, I'll try to deal with the other issue. The deficit today, the federal government deficit today is about 1/3 of what it was in 2009. We're going to come in this year somewhere about $500 or $550 billion in a deficit. It was nearly $1.5 trillion at the height of the recession, which is exactly what we would expect. During a recession, tax revenue falls and we spend more money. We would expect an increase in the deficit. It's been falling. Debt, you know, all of the stuff about debt to GDP ratios that we read is misleading. Great Britain for many, many years had 200% debt in relation to its GDP, and they didn't go belly up. There is no rule there. We can handle the deficit, we can handle the debt, we know how to do that if we perceive that to be a problem. Right now, I don't perceive that to be a problem. I'll quit there. I could go on all day long.
Well, it sounds like, in a nutshell, the beginning part of your answer, you, at this point anyway, don't seem terribly concerned about the labor force participation rate, that you're saying half of it's due to the aging population, but half of it to the economic conditions. I'm guessing that other half, some people are pretty concerned about, but at this point,
Sure.
you're not sure that it's something we should be alarmed about?
I'm not as a long-term trend, and I never get excited about one or two data points.
Okay.
This has been going on for a decade, at least. We peaked in the early 2000s on labor force participation in the United States.
At what point does it become a concern?
Well, you know,
What percentage?
if it drops 10 or 15%, we'd all be excited about it. But let me remind you, labor market issues last year when we were talking about this, I believe it was you who brought up, all of the new jobs are part-time. And that also was not the case. We have a weak labor market historically. What I worry about is long-term economic growth in the United States. We had four things that spurred economic growth in the 20th century. We had the best educated workforce, we had the healthiest workforce, we spent more on infrastructure, roads and the like, and more on R&D than anybody else in the world, and that was reflected in very strong growth rates. Those are the things that I worry about now. If you want, because we're not doing that, if you want a couple of additional things to worry about, the aging of the population, we can handle that. We're nowhere near the employment population ratio that we were in the 60s when we were taking care of a bunch of children. We can take care of old people and children. That doesn't scare me. Rising income inequality is going to be the issue that we're facing over the next decade or two.
And we'll get to some data points that address lots of those different issues as we continue, I'm sure. I want to get to our next question, though, because we've been waiting for that, and Bill Allen has been waiting, the president of the Chamber of Commerce. Hi, Bill.
Hey, Fred. Dr. Erickson, the state and the city are very dependent on the DoD, the government, for jobs. With the impending drawdown of the military, maybe a possible BRAC coming in 2017, what might that mean for our state and the city? And maybe as a second piece to that, we know we're losing the 2nd Engineering Battalion already. Shouldn't we do everything we can to not impact the mission of, say, our local base, White Sands, to make sure that we maintain as much as we can?
The major risk, and by the way, this has been driving the problem in the state. I mentioned that New Mexico's had very slow employment growth compared to other states in the country, and what is driving that is the decline in federal spending. Jim is saying that we're not likely to see a crisis this year, and that's of course true, but the fact is that under current law, I expect, and I'm kind of like Ken. Ken likes to mention when he had the forecast on the financial markets correct, and I like to mention when my forecast on the employment growth is correct. And I had forecast that we would drop about 1% decline in the overall baseline growth because of decline in federal employment. And in fact, we're seeing that playing out in the state economy. So, Bill, as you indicated, we're very dependent on DoD spending. One of the most dependent states, and on Department of Energy spending too, I should mention. And we need to be very careful about that. And I think that a top priority we should give is to the mission of the White Sands mission. I suspect you're kind of referring backhandedly to the transmission line that is very controversial right now. That is that the proposals, the people who propose the transmission line want to go through White Sands, and White Sands is concerned that that'll impact their mission. And I have to say I don't know enough technically about the issue to be able to comment on it, except to say that if it is negatively affecting our defense mission of White Sands, the defense mission of White Sands, that allowing that transmission line to go through would be cutting off our nose to spite our face. That it's really something we have to prioritize is the military mission, because that's such an important driver of employment and economic activity in our community. Just one last thing I'll say before I end. A few years ago, I did a study with some colleagues about the impact of military spending on our community, and it worked out to being about 25% of spending, direct and indirect, can be traced back to the military in Doña Ana County. And so the only thing that comes close to that is NMSU in terms of being a driver of economic activity in our community.
So enormously important. And we have another question.
Good afternoon, Ron Communis. I have a question that's not being expressed or answers are given regarding how Obamacare really impacts our economy when it goes into effect next year. You hear that a lot of employers are going to cut back their employees to 30-hour a week in order to avoid paying that. I just heard today that AT&T is pushing over several 100,000 retirees that are on their program next year, starting in January, into the health care option. They're taking it out of their private insurance. How is the impact going to affect the economy from the national level all the way down here locally? That's why I'm against the minimum wage going to $10. We just increased the GRT in this community. Now Obamacare. I don't hear you guys talking about that, so except for Chris, he's always talking about the minimum wage, and it's great. But anyway.
So let's address that. I mean, Dr. Peach, is this a situation where it is too soon to tell all of the effects of the Affordable Care Act, really, because it isn't fully implemented yet? We don't have full implementation.
It is not. First, I'd like to, a rare thing, I agree with my colleague Chris Erickson on the minimum wage, and that's not going to hurt us here. Obamacare, the Affordable Care Act, is a very, very complex issue to talk about. I have thought for many, many years that health care should be separated from employment. This is a wealthy nation, And whether or not you can get access to health care should not be tied to your employer. It is bad for business. It is bad for the individual. I would have gone much farther than the Affordable Care Act did in that regard.
Well, and some analysts, as you know, believe that that's what will happen long term as a result of the Affordable Care Act.
We don't know that yet. I'm not trying to just defend that act. I am very critical of parts of it, but there were some very good things in that act, including allowing children to stay on their parents' insurance until they're 25 instead of 21 in most cases, including giving access to health insurance with pre-existing conditions, an awful lot of stuff. The financing of it, quite frankly, I would take out of the hands of insurance companies altogether. It is much more efficient to have a single payer system. And Chris disagrees with me on that.
Okay, Dr. Erickson, if you could address, is it again, I'll ask that question again that really relates to the audience question, is it too soon to tell about how the Affordable Care Act will affect our economy locally as well as nationally?
Well, locally, nationally, I think it is too early to tell what's the impact's going to be. The impact on part-time workers appears to be very small, if any. You hear anecdotal reports of people moving from full-time to part-time because of it. And I know of some cases of some people who have been told by their employer that they're going to part-time because of the health care bill. But I don't think the evidence is very strong that that's a large impact. Here locally, and both the state and here locally, the funding for Medicare and Medicaid is increasing. Because we're a low-income state, we're going to receive a disproportionately high subsidy, and that is a positive for our state. In fact, one of the reasons why we had such an easy legislature this session budget-wise is because for the first time in anyone's recent memory, they did not have to ask for an increase in the Medicaid budget because the federal government was picking up the cost of the expansion of Medicaid. And so I think as a whole, it's a positive for our community. Coming back though, which I think is part of Ron's, really is his point, which is there's an awful lot of things that are coming along that are affecting local business. Increases in gross receipts tax, uncertainty about the Affordable Care Act, uncertainty, and then adding to that increases in the minimum wage potentially. And these are all things that make it difficult to run a small business. And I agree with them. I think that the uncertainty in our system is quite high by historical standard. It's less than last year though. The Affordable Care Act is beginning to work its way through the system. We don't have these budget crises in Washington, D.C. And I think as a whole that things are beginning to settle down. There's never a good time to increase taxes. There's never a good time to increase the minimum wage if you're a business person. But business people, I think, are amazingly adaptive at handling these sorts of things. I think that $10 an hour for the minimum wage, which is over 3 years, which is being proposed by CAFE, the group that is trying to get it on the ballot, is very high. And it would be, I think that a more reasonable approach of $8.50 an hour that's being proposed by at least some members in the City Council is something that's more easily handled. And that, in fact, would still be lower than it was a couple of years ago when you adjust for inflation. So I think that's something that people can handle. And I think that there is no alternative. There's going to be an increase in the wage. I think the politics are just such that that's going to happen.
Okay, and before we get to our next question, one final point on this, because it happened this week, so it's very relevant. Federal Reserve Chair Janet Yellen, speaking before a congressional committee, did mention real concern about one of the issues that were addressed in this whole debate, and that is the part-time employment. She said she's very concerned about an historically high number of people who are so-called involuntary part-time workers folks who want a full-time job but are working part-time. She said it was about 5% of the total labor force, historically high, and a concern for the Federal Reserve Chair. And our next question now, Zach Quintero. Hi, Zach.
How's it going, Fred? Thank you for having me, and thank you again to the Chamber for co-hosting this. It's a great honor to stand with some fellow academics and everything. I know it's finals week for us all students, so it's hard to get here, but I definitely wanted to make the trip. So my question is in a three-tier piece all over. I think each of you can definitely answer it. Dr. Peach, if you could talk a little bit about immigration reform on the national level and what we can expect from that in terms of the economy, in terms of statewide growth as well. On the state level, if I could get Dr. Erickson to talk a little bit about international development between Mexico and Latin America. We have one of the biggest ports here in the country. Tell me why we don't have more economic activity coming through this state. If you could tell me, Dr. Martin, about what I call the student economy. Right now, the debt for students is $1.2 trillion, and it's matched the household income of credit card debt per family household. So if you guys could just have some fun with that, that'd be great.
All right,
Thanks.
Dr. Peach, we'll start with you.
Sure. The first part's really easy. I don't think we're going to have immigration reform this year. It is long overdue. Our immigration laws are an absolute mess. And immigration is something I've watched for a long time. I've written about it. You can look up what I've had to say, but what I'll tell you this afternoon is that immigration policy attracts strange bedfellows. The last major immigration reform we had was in 1986, the Immigration Reform and Control Act of 1986, and that was also known as the Simpson-Rodino bill. Simpson was a conservative Republican senator from Wyoming. Rodino was a very liberal Democrat from New Jersey. They paired up to do immigration reform. You're going to get people on opposite sides of other issues that can sometimes come together on that. You're going to get, it's a mess.
But
we're not going to get it this year. It's an election year.
If we got it, though, do you believe this would be a net benefit as far as the economy locally and nationally?
When you say it depends on what it is. The U.S. Senate actually passed immigration reform last year.
And that's what I
in the
was
form
referring
of
to.
Senate
The
Bill
Senate bill, comprehensive reform.
756, and it passed the Senate. The House did not take action on it. It, like all immigration legislation, had all kinds of provisions in it, several hundred pages long. The main thing was, in the Senate bill, there was a path to citizenship. We have a real dilemma here. If we are a nation of laws, we have ignored immigration law for a long time. But if the estimates are correct, that we have 11 or 12 million undocumented people living in the United States, there is no possibility that we're going to round up all those people and send them somewhere else.
So
None. I don't care what
so you believe
think
it could
about
be a benefit to the economy, is what you're saying?
So, yes,
Okay.
legalization is a huge benefit.
And of course, that theoretically then would mean 11 or 12 million additional folks contributing in new ways to the economy.
In new ways.
So,
a lot of them are already in the labor force, but you could bring a lot more into the labor force. It will affect different states differently.
Okay. We're running out of time.
Yeah.
Dr. Erickson, if you could address Zach's question about what some people believe is one of our biggest hopes in this region, and that is this import-export work. And we certainly have a new rail yard in Santa Teresa. Let's talk about that.
Yeah, well, the railroad in Santa Teresa, the rail yard in Santa Teresa is the biggest economic driver in our community right now. It is unequivocally something that is going to attract businesses in here. I imagine that I suspect, and this has historically been the trend, that most of the manufacturing facilities will locate in Mexico near the Foxconn plant, which of course is down there already, a very, very large facility. And then on our side of the border, we'll see a lot of drayage and warehousing activity. But those are good jobs. Those are good middle-class jobs. Those are good blue-collar jobs. And I view this as a real positive, particularly as the economy begins to recover, which, as Jim pointed out, it is doing as we move to 3% growth on a routine basis going forward, we should see an excellent growth coming from that area.
Okay, Dr. Martin.
Student debt. Oh my goodness. That is a ticking time bomb, and it's going off for some students, obviously. And maybe one of the reasons why household formation is slower than it used to be and needs to be. There's no easy cure for students who are just getting out and facing that debt. It's just one directive.
Okay.
Do what you can to pay it off.
So it is a concern, very interesting. And it sounds like we may have time for one more question before we wrap up our program, and that is again Bill Allen. Bill.
Dr. Erickson, I appreciate your and agree with your point on the 10-10 an hour. I'm going to summarize one thing that you said, and I hope I got it right. For the individuals that are also receiving government assistance, the way that you talked about the increase in minimum wage, the way I understood that is the burden, it would kind of balance differently, and the burden would fall on the employer and less on the federal government. Is that correct?
That's right.
Let me ask you a question about, I guess, the onus on whether it should be on the employer or the employee. If we have a couple, maybe 300 jobs available right now in Las Cruces that it's currently paying $2 above our current minimum wage, shouldn't there be some, as I said, onus on the employees to increase their skills to take those jobs and maybe make room for minimum wage jobs for the teenagers that you also said would be impacted?
Yeah, I think that one of the side benefits of an increase in the minimum wage is that you tend to increase the quality of the workforce. Because employers are paying more, they want to make sure they get the productivity from the workers, and they tend to train those workers better. They tend to hire more efficient workers to start with. And of course, that's good news for people who are not at the very bottom of the skill level, but are maybe one notch or two notches above that, because they find that there's more jobs available for them. But the kids, and particularly teenagers who are at the very bottom of the skill ladder, are going to find it difficult to get work with a higher minimum wage. I mean, that's what's been found almost universally where the issue's been studied, is that the very least efficient workers lose out and the more efficient workers gain. In some sense that's good, because that means those kids will have to stay in high school, they'll have to continue to get education. But in other ways it's bad, because of course one of the best ways to gain skills and to become more productive is to actually have a job and work and learn work skills. So I agree with you that that's right.
This is related to low-wage employment, so I'm glad we had a minute or two to address it. Dr. Peach, this week a report from the Employment Law Project found something that many folks are really concerned about, and that is, as we look at jobs coming back, what about the quality of the jobs? And their project study found that lower wage industries constituted 22% of recession job losses, but 44% of recovery growth. What are your thoughts?
And it's part of it's not just the recession. It's part of a longer term trend. The real median wage in this country is stagnant and has been for 25 years. We have almost the same real median wage and in many, many industries and overall that we did in 1986.
Does this concern you?
Of course it does, and it's part of the larger inequality problem. You know, we got all excited about Tesla perhaps coming to New Mexico with a battery factory. Now, minimum wage people are not going to buy an $80,000 car that can only get you most of the way to Albuquerque. You know, if you want success in industries like that, we have to have a distribution of income that would allow large numbers of people to buy things like that. It is the issue. We have rates, no matter how measured, of inequality that we have not seen since before World War I. We made great progress in reducing inequality after World War II. Since the early 1970s, inequality has been going up. We've got a huge problem there. And, you know, it is not an easy thing to solve. We know how to do it, haven't done it.
And it's a long-term thing. Dr. Martin, do you worry from the financial market perspective, if this trend continues, about how this will affect as well our entire economy and the financial markets? If people don't have that optimism of at least maintaining their standard of living, if not increasing it, what will that mean in your mind?
Well, sentiment is a big factor in driving asset prices and stock prices, and in driving, and you see it these days in the initial public offering market as these startup companies go public. The more optimism there is, the higher the sentiment is, the more these companies can raise money from the capital markets and their stock prices rise. Now, eventually, those things reverse too. Those go in kind of in waves, and lately the IPO market has been kind of not as robust, I'll say. Still, I think this problem that Dr. Peach is talking about, it would be kind of a second-order effect in the stock market. Stock market is worried about revenues and earnings, and to the extent that companies can keep increasing revenues and increasing earnings, then that's going to support stock prices. We have a long history in the United States of ups and downs, and
at least the dialogue has begun, because that's where
up.
solutions begin at all levels. So we appreciate your insight, Dr. Martin, Dr. Erickson, and Dr. Peach, sharing this with us and our viewers. And we thank again the Greater Las Cruces Chamber of Commerce for partnering with us on this event, and all of our members. You make in-depth journalism possible in our community. Thank you. I'm Fred Martino. Have a great week.